Folks, welcome to Falcon Capital's webinar on the new macroeconomic realities for investors in commercial real estate and specifically in multifamily in 2023. We have participants and attendees here on Zoom. We're also live streaming on Facebook. So I'm very glad that you could make the time on what is obviously in the middle of the week. So we really appreciate it. Hopefully this will be educational. Our goal is to bring you some relevant and timely and cutting edge data, which will help inform your perspective and your investment decisions. So let's jump right into it. Here are 2 cents from our lawyers. It's a disclaimer. And essentially, I'll let you read through it, but largely speaking, we're not investment advisors, and this webinar is provided for educational purposes. As you know, all investments, whether they're in stocks, real estate, involve different degrees of risk, and you should be aware of your risk tolerance level and financial situation. And I'll just leave the slide hanging here for a few seconds, and then we'll get right into it. I know some folks are still joining us, and we have folks from California here on the East Coast, and then again on Facebook. Thank you for making the time to join us for this Falcon Capital webinar. Much appreciated. Folks, I'm Madhu Ramaswamy, managing partner at Falcon Capital. My co-founder is Amit Goyal. We're both physicians. I'm a pulmonary critical care doctor. Amit is a neurosurgeon. We have been investors in real estate, specifically in multifamily, since 2016. I am board in critical care medicine and clinical informatics, so clearly not an economist by trade, but I think we recognize the importance of educating ourselves and our investors on macroeconomic factors. And that's what sort of drove us to bring this talk to our investor base. As you know, Falcon Capital is a private equity firm. We're based in Washington, D.C. We focus on real estate, specifically multifamily. This webinar is really about how macroeconomics impact our investments and hopefully your decisions. But this is just a brief introduction to our company. We have over $115 million in assets under management. With about 20 plus years of combined experience, we operate 6 multifamily assets in 4 different states and have a knowledgeable team that stands by to support you with white glove service. In terms of the webinar, we'll sort of keep it fairly structured. I welcome questions. Please drop them in the chat room in Zoom. And at the end of this, I hope to wrap up in about 20 to 30 minutes. And at the end of that, I'll be happy to answer the questions you've dropped along the way and ask for more. I think we're hoping to have a fairly lively discussion, and we'll touch upon commercial real estate asset classes. We'll talk about inflation and interest rates. We'll talk about the federal funds rate, cap rate or capitalization rates, and how movements in cap rates driven by what's happening in the economy creates investment opportunities, and briefly touch upon a few other trends shaping commercial real estate. So, folks are all pretty sophisticated here, but commercial real estate has several asset classes within it. There's the office, the retail, your strip mall, there's hotels, there's senior housing and care, there's medical. But the largest piece in the commercial real estate landscape is actually multifamily. And the next is office, which is making a lot of headlines given a lot of distress that we're hearing, especially coming out of the West Coast, San Francisco. Multifamily is very interesting and very unique because when it comes to financing multifamily, amongst all the asset classes, it's unique because the federal government stands behind it to some extent by providing liquidity for transactions. And that's by Fannie Mae and Freddie Mae, just like they make loans to single family homes that you and I might buy, they also do that for multifamily. So multifamily has that going for it. And it's also one of the reasons why it's been a very resilient asset class. Actually, it's been the best performing asset class within commercial real estate for the last 5 to 10 years. And that's why it has been a source of great interest to individual investors, especially as the syndication model came in over the last 10 years, is given a chance to rank and file investors who are accredited typically to get into this asset class and sort of benefit from the resilience and the returns it has provided. So as you can see, in terms of transaction volume within commercial real estate, multifamily has been rapidly growing. It is almost 40% of the transaction volume in 2021, and actually furthermore so in 2022 and 2023, it remains so. Now, we're clearly here to talk about macroeconomics, and I think all of us have had to have a real education in interest rates, what that does to debt, especially in the last 1 year. I think for the last decade, we've enjoyed historically low interest rates, and that created economic conditions. And now we find that within the last year, to grapple with inflation, the Fed has been on a march to increase interest rates. And with that, we've seen some very fundamental changes in how transactions are being conducted. And I think we find that as investors and operators, it's very important that we pay ever closer attention to these factors. Now, the annual rate of inflation actually peaked sometime in mid-2022. It was June 2022 when it hit 9.1% right here. Since then, we've had 8 to 9 straight instances that the inflation rate's actually been going down. However, the US consumer prices still remain elevated, and underlying or core inflation does tend to tick up high, as it did so in February. And since then, it's again been a little bit up and down. What is interesting is that sometimes you hear inflation numbers and they're quoted as being 9%. At other times you hear numbers like 1%. And I think it's key to remember that inflation rates, there are both monthly inflation rates and annual inflation rates. So there's a 12-month comparison, which is what, when I said the rates peaked at about 9.1 in June of 2022, that's what we were talking about. And then there's the monthly inflation, which is this blue graph here, which has sort of been hovering around 1.5%, 1.2%, and that's a month-to-month change. And this sort of graph here is the consumer price index, which is a basket of different commodities that is sort of looked at together. And the Fed uses this to judge where things stand with inflation. And that sort of helps it make decisions on what they'd like to do with interest rates. Now, inflation is one of the metrics used by the US Federal Reserve to gauge the health of the economy. Since 2012, typically the Federal Reserve, or the Fed, has targeted a 2% inflation rate for US economy and makes changes to monetary policy if inflation is not within that range. A very notable time for inflation was the early 1980s. During the recession, inflation rates went as high as 15%, causing the Federal Reserve at that time, led by Paul Volcker, to take several actions, kind of like what we're seeing now. The Federal Reserve tends to keep the Fed's fund rate, or the effective federal funds rate, EFFR, within a 2 to 5% sweet spot that helps maintain a healthy economy. But there have been exceptions. The nation's benchmark rate has been increased well above that range at times to curb runaway inflation, like we're seeing now. It has also dipped well below 2% to stimulate economic growth. So when we hear the Fed raises the rate, we're talking about the EFFR, the effective federal funds rate. And that's the interest rate at which depository institutions, banks, credit unions, they lend, so to speak, to each other. And that's kind of where you find other lenders calculating their interest rates. Now, when we hear of the Fed meeting, what we're actually talking about is the Federal Open Market Committee, which meets 8 times a year. They last met in the early first week of May. The next meeting is, I think, around June 13th or 14th. So the current Fed rate as of May 15th is 5.08%, which, if you think about it, is staggering because it was near zero during the pandemic from 2022 until March 2022, from 2020 until March of 2022, when the Fed started raising the rates in response to runaway inflation. But even if you look back prior to that, 2018, 2019, we were hanging in the twos. So to go from 0.25% or effectively 0 to 5% is 500 basis points. That is the steepest increase in interest rates that we've seen in 40 years. This is a sort of almost unprecedented time for this generation of financiers, lenders, bankers. And I think nobody, including the large banks, which have access to reams of data, were saying or predicting this level of interest rate hikes in 2021 or even early 2022. So clearly, this has caused an incredible amount of rapid changes in the in the economic conditions that we're dealing with currently. The interest rates and inflation are obviously intimately related because the Fed uses the interest rate as a tool to manage inflation. the EFFR indirectly impacts inflation by affecting borrowing costs and economic activity. It's important to note that these relationships are complex and subject to various factors and considerations, like central banks worldwide, like the US Fed, carefully analyze economic indicators such as inflation rates, employment levels, and economic growth, and then they make a decision to adjust the interest rates and the EFFR in pursuit of what they consider a stable economic condition. So clearly, in a setting where there's low Fed fund rate, borrowing becomes cheaper. There's more lending, which allows for increased spending and investment, and this potentially can contribute to inflation. Similarly, a high EFFR reduces spending and investment, and it helps to cool down inflation, which is what the Fed is trying to do at this point of time. You can see on this graph, the blue graph or the blue line being the EFFR, or the Fed fund rate, and the yellow line being the inflation. And you can see the correlation between what happens when there's a recession, as we saw in 1980s, the dot-com burst, the 2008 financial crisis, and then what happened during the pandemic when we experienced a very brief recession, which is, as you know, defined as 2 consecutive quarters where there's contraction of the GDP. Now, what's very interesting is that starting March, the Fed started hiking the interest rates. We have almost had an interest rate hike, as we said, of 5 percentage points or 500 basis points. As you all know, basis points are jargon, essentially saying that 1 percentage point is 100 basis points, so 0.5 percentage equals 50 basis points. So we've seen almost 500 basis points that have been increased since March, in about a year. What is very interesting to note is that the Fed itself says that it takes 9 months for an interest rate hike to wind its way through the economy and make its full impact. Real estate typically lags behind 6 months. So essentially what that means is, as of today, the economy is processing the hike that happened in September, which took the rate from 2.5 to 3.25%. So we only absorbed the first 300 initial basis points. There's another 200 basis points after that we're yet to even see have its true impact on the economy. And then come June, it's anybody's guess if the Fed will raise the rate or not. Some folks think that the Fed won't this time around, and maybe come July or their next meeting, they're likely to have a look at it again. But the consensus, it seems like, is we can expect another 25 to 75 basis points increase before the year ends. Now, the whole goal with all of this is that the Fed is trying to cool down inflation, and there's always a concern when the rates go up that we may see a recession. And I think the Fed's goal here is to ideally dodge a recession, or at least have a soft landing. But what's interesting is, in spite of this rapid increase in interest rates and every attempt to cool down the economy, the American job market is strong. Unemployment is stickily low. It is very hard to have a recession when the economy is adding greater than 200,000 jobs every month. And that's a fascinating statistic. So we are now in this zone, as I said, for the first time in almost half a century, with unprecedented interest rate hikes, unemployment remaining stubbornly low, and inflation rates remaining stubbornly high. And there are, of course, geopolitical factors, supply chain constraints, all of that thrown into the mix. And that is why it's very imperative for us as investors to be cognizant of and be aware of what are the macroeconomic factors that impact our decisions. So tying this all into commercial real estate and investments, you're all familiar with cap rate. If you've looked at an investment slide deck or a summary, folks will always talk about entry cap rates, exit cap rates. One of the primary uses of cap rates is to determine the potential return on investment for commercial properties. It serves as a benchmark for valuing commercial properties and a tool to assess what the financial performance and value of a commercial real estate asset might be. Investors often compare the cap rates of different properties to assess their profitability, and then they make informed decisions about where to allocate their capital. Generally speaking, higher cap rates indicate higher potential returns, but they also come with increased risks. So in terms of a formula, a cap rate is essentially net operating income divided by the value of the property. So cap rates and property values have an inverse relation. As cap rates go down, as cap rates go up, property values go down, and vice versa. Cap rates go down, property values go up. The NOI, as you know, is a property's income after deducting operating expenses, so income minus expenses, but before considering debt service or taxes. Essentially, it represents the cash flow generated by the property. So a cap rate, if essentially a property was worth $1 million and had a net operating income of 100,000, the cap rate would effectively be 10% or 0.10. Now, why does this matter? It matters because cap rates are influenced by multiple factors: market condition, location, the quality of the tenant base, the asset class, and the perception of risk. Higher cap rates, as I mentioned, are typically associated with higher levels of perceived risk, and lower cap rates are associated with lower levels of perceived risk. In a strong economy with high demand and low supply, cap rates tend to be lower. Conversely, cap rates may be higher in a weaker market or with higher risk properties. But currently, there's one big gorilla which is shaking cap rates, and that's interest rates. If you look at the relationship between cap rates and interest rates, in this case, the graph that we have shows the 10-year treasury yield in orange, and the blue graph line represents the cap rate specifically for multifamily, because cap rates vary between asset classes. The multifamily cap rate is different than office cap rate. Similarly, the cap rate number varies between regions. Between, let's say, Phoenix, Arizona, and Washington, D.C., there's a difference in cap rates. Not tremendously, but there is some variation. So it's quite local, as we mentioned. During the Volcker years in the 1980s, the Fed increased rates aggressively, pushing 10-year treasury yields higher. With the expectation of a Fed pivot currently in the next few quarters, the cap rate spread may start to widen. And this gray area is the spread between the interest rates and the cap. So the further apart these are, the larger is the spread. In the past, whenever the Fed starts reducing interest rates, the spreads witness an instantaneous expansion, meaning cap rates start to drop. The point being that we expect that the Fed will continue to raise interest rates by 50, 75 basis points over the next 2 quarters. But the expectation is also that come Q1 of 2024, now no one has a crystal ball, there's likely to be some reduction in the interest rate at that point of time. The savvy investor will be well positioned to take advantage of the situation at that time, because based on this graph, as soon as the Fed indicates that they're lowering interest rates, cap rates start to drop. So let's use a sort of an example to understand how that should impact our decisions in terms of investments. Now, we know that come Q3, Q4 of 2023, there's going to be distress in the commercial real estate sector. And that's primarily from an inability to service debt and inflation driving costs. We're already seeing several defaults in the office space sector. There are entire large buildings in San Francisco downtown that have foreclosed on, have been returned to the lender. The keys have been handed over. The Wall Street Journal widely reported a case in Houston of a multifamily operator that had to foreclose on almost 2,000 plus units. So there is going to be some distress in the sector because of the simple inability to service debt at the current interest rates. Because what happened during 2020, 2021, 2022 is a lot of floating debt that was taken on by operators, which had variable rates. And those loans that originated in 2020 and 2021, they are due right about now, depending on the term of the loan, 2 years or 3 years. And this is just the reality. Now, if you take a market like Phoenix, which is pretty solid fundamentals economically, there's new industries coming in there, EV companies, battery makers, tech folk, there's net migration into Arizona. What we've seen is cap rates have dropped, cap rates have expanded or risen from 4.25 to 5.75 in just 6 months. That's a 125 basis point increase. Now, remember, as cap rates go up, values go down of assets. Based on a 125 basis point increase in cap rates, values of assets, some assets is down as much as 25%. It's possible that by the time the interest rates take its full effect, we may be seeing discounts of as much as 30% or even more from the peak. Peak was probably sometime in 2022 or end of 2021. So we're going to see discounts on the prices or valuations of assets. So the question becomes, if we were to pick up as an investor some assets in Q3 and Q4 at this discounted rate, what happens when the interest rates start going down again in 2024? Now, nobody's expecting interest rates to return to 2, 3, 4%. No, that's not what we're saying. We're probably going to remain in a 4 or 5% Fed fund rate, and on top of that, you add another 200, 300 basis points that the lenders will charge for the foreseeable next 3 to 5 years, barring major changes in geopolitics and global economy and the US economy. So let's take an example. If we're able to take advantage of these discounts from the peak and buy an investment property in multifamily or another space in commercial real estate, when interest rates start to go down again, the first signal the Fed gives, we're going to start seeing a pretty significant drop in cap rates. And if the cap rates drop just by about 75 basis points after having gone up by 150 basis points, that means the cap rates will go down from 5.75 to 5.0. When that happens, that is a significant amount of value created, because as cap rates go down, valuations go up. So if you take the example of a $30 million property where perhaps there's $10 million in investor equity, $20 million of debt, that drop in cap rate from 5.75 to 5.70 to 5.0 essentially adds $5 million of value to the equity. Essentially, you're halfway to doubling your equity on that $10 million investment that we as investors might bring in. So the whole point of this is to tie together how movements in interest rates based on what the Fed does causes fluctuations in cap rates and asset prices, and there are folks waiting to capitalize on this movement. Now, multifamily is a sector in this whole sort of climate of what can potentially be some amount of negative news that is likely to snowball over the next 2 quarters. Multifamily stands in a position to weather this most likely better than other asset classes in commercial real estate. And there are some very fundamental reasons for this. If you look at this slide that I have, which is a few graphs, and I'm sorry about there being 4 graphs on this, it's very clear that home ownership is less affordable today than ever before. The median home price is still 35% above where it was in 2019, and a major correction is not expected given the underlying dynamics, fundamentally because supply and demand of housing in the United States is very tightly matched. We are fundamentally in a different time than 2008, when there was a glut in housing. There was availability in excess. Today, home construction, whether it's multifamily or single family homes, never really reached the level of construction that we had in 2008. Meanwhile, the US economy has been going blazing, and we've seen net migration into high areas with high economic activity. All of that means supply demand is tightly matched in many markets that are performing very well economically. In addition, the number of home listings remain well below historic averages and will likely remain limited as people stay put in 2023 with economic uncertainty, and there'll be some softening in hiring activity, depleting the motivation to relocate. In addition, many owners are locked into historically low rates and have little incentive to replace that mortgage in this new environment. Then there's the question of millennials and Gen Z who are just more inclined to rent. And then there's broad-based inflation and career advancement uncertainty, leading many US residents to tighten their household budgets. In addition, we're seeing that regionally robust sort of inward migration in the Sun Belt states, the South, the American South, the Florida, Carolinas, Texas, and those are the markets we're primarily invested in at Falcon Capital. These are high economic activity markets, seeing high rate of inward domestic migration. You've got population sort of dropping in the coastal areas because of high cost of living, moving towards areas of high economic growth. Tax policy helps as well. These trends will change living preferences and create a more renter-disposed society, which favors the cost-saving benefits, flexibility, and lifestyle advantages that renting offers. Essentially, the US is gradually shifting where the renter pool is going up every year, aided by the factors I mentioned: housing, affordability becoming harder, and economic uncertainty created by what's going on. And of course, this slide is more saying, thank God we made it to 79, meaning that with the whole debt ceiling crisis that was looming over, the debt ceiling had been raised 78 times without default since its inception in 1970. And there were all these doomsday predictions. Of course, not sure if anyone ever believed we'd get there, but it was never impossible. The Council of Economic Advisors essentially put out some very, very damaging estimates in terms of what that would have done to the economy. Luckily, we're not left dealing with that. Well, that sort of concludes my brief take on what's happening in terms of macroeconomics. This is just a slide about us showing sort of what we have so far done. As we mentioned, we are primarily in the Sun Belt states, in the Texas, the Carolinas. That's where our assets are. We have a one-off in Indiana, which actually happens to be in an MSA called Elkhart South Bend, which got ranked #1 MSA in a recent Wall Street Journal article for economic activity. So we pick and choose our investments in areas we believe that are positioned for high growth in terms of net inward population and job diversity supporting it. Where we have pages on Facebook and LinkedIn. We're always trying to put out educational content such as this. Please feel free to email me with any questions you have or schedule a call with us. We're always happy to connect with our investor base and folks who'd like to just know a little bit more about what we're doing or just want to discuss what's happening with commercial real estate. With that sort of brings me to the end of my presentation. Happy to take any questions that we might have. I'm just going to take a peek here in the chat box to see if you folks had any questions or thoughts that you'd like to hear from us more about. Once again, folks, thanks for joining us today. We're also live streaming on Facebook. We really appreciate the time to bring this to you. Our goal is to keep up with our webinar series where we're bringing germane topics to our investors. And please feel free to email me. I don't quite see any questions quite yet. Actually, no, we have something. Here we are. The question being asked is, does rent inflation lag general inflation? So this is an excellent question, and I'll just take us back to a slide that we have about the consumer price index. And you will notice there that housing is shelter is a component of it. What we have found is something fascinating. Over the last 2 years, in 2021 and 2022, there was historic rent growth. In some markets, 8, 9, 10%, totaling over 2 years in some markets to almost 20%. So clearly rent growth kept up with inflation and even overshot inflation. Generally speaking, rent inflation stays in tandem with general inflation. And usually we always say is about 100 to 200 basis points above inflation. But now we find that in many metros, rents have essentially peaked, plateaued. We're also beginning to see a slight downtrend in rent in some markets that had clearly really pushed rents up very high. But at the same time, most markets, and I was looking at data from CBRE recently, most markets are still factoring in rent growths of 3 to 4% annually. So when we underwrite our assets, to make projections, we take a very conservative 3%. This was even when inflation was running at 8 or 9%. But rents will continue to rise, barring some markets where I think they've just been pushed to a point where the market can't support it anymore. So that's a great question. It actually doesn't lag, it stays lockstep. And that's why it's very interesting, multifamily or apartment complexes where lease terms are short. You can have lease terms month to month, 6 months, a year. Apartment complexes or multifamilies able to adjust the rents much more quicker than, let's say, if you were in a large office building where the leases can sometimes be much longer. So we're able to adjust for, as a sector, inflation much quicker. So hopefully that answers your question, and that's a great question. Folks, thanks again for joining. This has been fantastic. Really do appreciate your time. And we look forward to continue engaging you with our newsletters and bringing more educational webinars to you. Have a great evening and a wonderful rest of the week.